on to the markets. In Nigeria, we see the market falling for a third straight day today. We see the NSE All-Share Index closing at 33,466 points, down about 0.6%. Today, the pressure really came from Dangote Cement. Usually when that stock moves, the index moves in the same direction. We also saw losses in companies like Nigerian Breweries and Guinness. And in the banking space, we saw Diamondback bounce back up 8% after it reported its first quarter results, while Access Bank and FBN Holding, the holding company for First Bank, fell by 2.5% and 2% respectively. Let's now cross to Rele Adesina. She's head of research at Stanbic IBTC, and she's standing by to talk us through her thoughts on the market and the banking sector. Really, it's good to have you on our show. I want to start first of all by getting your thoughts on the trend we're seeing in the markets. Down for the third consecutive day today. It's beginning to be a little worrying, especially when you consider the context of the results we've seen so far.
Well, I disagree. I think we're easily worried, is my view. I think that, we tend to track the NGSE 30, and I think at 1660 it really overshot. I take it back to our 4-year fair value for the NSE 30 is 1600. So when we saw it get to 1660, we kind of expected some kind of retracement. Right. Obviously, the retracement was kind of probably exacerbated by people's disappointment with Diamondback, not because the weighting of Diamondback in the index is so high, but just because maybe there's some sort of sentiment element to people taking profits on other banking sector names. All right, so let's focus on Diamondback.
Of course, it reported its Q1 numbers after reporting its full-year numbers just the other day. And your thoughts about the result? The big takeaway for many is the rise in operating expenses. Of course, it's bounced back to a profit after the surprise last year, or rather in the year before. So your thoughts on where Diamondback is right now?
We are still comfortable with the name. Quarter on quarter, the operating expense trend was constructive. If we think about Diamondback Q1 last year and Q1 now, they have been in a more expansive phase. So if the operating expense base is larger than it was Q1 a year ago, I'm not totally surprised. Their cost to income ratio annualized is 60.7, and we are expecting around about 59% for the year as our forecast stand at the moment. So we would expect to see some improvement in that trend as we go through the year. But if we bear in mind that loan growth was very muted in the first quarter and ought to really be stronger as we move through the year, that's probably less of a concern for us also. All right,
9% growth in deposits. That seems quite impressive in the context of where Nigeria is right now. Your thoughts on that?
Well, again, the aspiration for everybody is to drive current accounts. Diamondback have obviously had a bit of a head start in the retail space, but I think also they've been driving more activity at the sort of higher end of the market. When there was a change of management, you may recall that our thoughts were, our expectation was that Diamondback probably had a decent chance of executing on its strategy of growing Tier 1 and growing the retail, simply because they had a new MD that has a sort of strong pedigree in the Tier 1 banking space. Right. So as expected, Mr. Oti has driven the sort of Tier 1 loan growth, particularly in the oil and gas sector, which no doubt would have also helped them in terms of high-end deposits, and then the momentum in their retail business will help the low-end deposits too. The trend in the market is for slightly more expensive cost of funding, and we've seen an uptick, but nevertheless, they're still faring far, far better than fellow Tier 2 players.
Right, and of course, they have announced plans to raise new fresh capital. $750 million number has been put out there. It'll be interesting to see how it works out over time. But your thoughts about the need for Diamondback to raise capital right now?
Oh yes, I mean, clearly, again, this is something that we have been highlighting concerning this name for a while, and indeed they've been highlighting, to be fair. Our expectation was that they wouldn't raise, tier 1, because, if we think back to a year ago or 9 months ago, the valuations were pretty weak. Right. The valuations have strengthened, considerably, and we think that they will firm up further once we get over the sort of Q1 reporting season. So, if you're trading at book value, perhaps, Tier 1 looks more attractive than it did when you were at 0.5. In addition to that, there's a limit to what can be done as Tier 2 capital based on their balance sheet size. So some mix of Tier 1 and Tier 2 looks to be what is necessary. And it's essential for them to be able to sort of move past this kind of mid-teens level, which is right on the nose of the comfort zone that I guess people have, and will impede their growth if they don't raise capital.
Right. If they do raise some equity capital, your thoughts on the pricing of the stock right now? I think many people still feel the upside for Dermamark is pretty high.
Yes, I mean, we have a target price of 8 naira 10 kobo. You know, we have to say that we didn't necessarily expect them to pay no dividend. So, you know, we had the stock had rallied quite considerably in the early part of the year, and we had cut the recommendation to a hold purely on those grounds. But now that it's sold off, you know, we can see that you know, our target price remains intact. So you know, it looks a little bit more attractive as a name at these levels.
All right, and the retail banking business in Nigeria these days, your thoughts on how that is playing out? Of course, that is a big focus of Diamondback.
Yes, and I think increasingly of other banks. You know, other banks that had, you know, a year, 2 years ago dismissed retail as kind of, you know, not particularly relevant for their strategies. I think that gradually we're seeing that kind of polarizing. So the highest quality names plus the retail. You know, obviously if you push into the retail space, Diamondback has demonstrated the advantages, particularly for a second-tier bank, of being able to source cheap funding. But on top of that, if you actually figure out how to lend to that segment, then you can also support your asset yields, particularly in an environment where yields are compressing as they are now. So I think the Diamond is still ahead of the pack in terms of lending to the retail space, but we'll certainly see more of an effort across the board in terms of sourcing deposits from there, and gradually, as the industry sort of takes certain initiatives, we'll see, I think, an increase in lending to the retail space. But lending will be slowish for now.
If we can come very quickly back to the numbers, NPL ratio down to 4.6% from about 8% a year ago. It seems definitely in the right, direction. But your thoughts about that 4.6% number? Would you say that is a comfortable number for the type of bank Diamondback is, or you would like to see that number fall back more?
Well, I mean, I think, you know, a lower NPL number is always welcome, but I think, having said that, you know, if you're going to lend to sort of the retail and MSME type customer in this environment, the expectation should be that there would be an NPL ratio that is higher than someone who lends almost exclusively to tier 1 corporates. I mean, that's a given. So being below 5%, I think, is you know, comfortable. And you know, if they can maintain that level and have the benefits of cheap funding and decent asset yields, I think it's a reasonable price to pay for that.